More on what this means for the U.S. economy, or for that matter, the global economy. Thomas Hayes, founder, chairman, and managing member of Great Hill Capital. Good to see you. I love having you on the show, especially on days like this, because first of all, they should really kill these press conferences, because had he just made the decision and then stopped talking, I think the markets would have been fine. But then he started talking, giving this idea or hinting that there could be 2 more rate hikes. And I don't understand the purpose of that, other than to ruin the celebration, if you want to call it that, for lack of a better word. Why say that?
Well, this was a hawkish skip, and thanks for having me, Phil. I love coming on with you. The idea here is they need to continue to anchor long-term inflation expectations. So we believe the Fed is done. And why do we believe the Fed is done? Because the base effects from last year are at their most pronounced for the June data, which will be reported in July before the meeting on the 25th and 26th. And specifically, the key component in that is owner's equivalent rent. And I'm sure you've looked at the Redfin numbers and the Zillow numbers. They're really declining. And that's about 1/3 of the weight in CPI. Those numbers are going to give them more than enough cover to skip again in July, which is going to lead to a pause where they'll keep rates elevated through the end of the year.
When they say data dependent, are you referring the data they're looking at is this owner's equivalent rent, or is the data used cars and the price of eggs? Which one is it? Because all the numbers that we've seen has seen a significant pullback, albeit though the caveat is I'm hearing used car prices are inching forward again and some other things, but it sounds like to me that that's not the data they're looking at.
Well, the key is the weights, and they assign close to 40% weight on owner's equivalent rent. So that's going to be a key component. And if we look at the base effects, that's going to be very positive. We're going to see a 3 handle on headline inflation next month, and it could be even at low 3s. And that's really going to change sentiment around inflation expectations, and really give the Fed cover to pause yet again. And this is very constructive. So the dot plot is what spooked everyone, where I think what you're seeing is Powell has now moved more dovish than his colleagues. This was a concession where he would say, let's skip, let's see more data come in. He's worried about the banking instability that we saw a few months ago. He doesn't want to break more things. I think they put 2 banks under that didn't need to go under, of the 4 that did go under. And the dot plot is basically saying there's more there if we need it, but more likely than not, we're not going to need it. As a matter of fact, Nick Timiraos of the Wall Street Journal called him on that in the press conference. He said, if you're all so hawkish, why didn't you just hike and pull the Band-Aid off today? And he kind of fumbled and said, well, projections can always change.
But isn't it also a credibility issue? They've been saying, we're fighting inflation, we're fighting inflation, we're fighting inflation. Okay, so inflation has come down. I think the last number I saw was sort of around 4%, depending on which number you look at. And I get it, but I still stand by the fact that 2% is not a realistic number if you want your economy to be growing at the pace it's growing at. The only way that 2% makes sense if you don't want your economy to grow at all. So he's stuck. He's put himself into this position where he has to have the credibility to say that we're going to keep fighting inflation, or at least insinuate that you are.
Yeah, and to your point exactly, Phil, 2% inflation would be a complete disaster when you have debt to GDP at 120%. The only way to bring that down is the way we did it post-World War II, which is to run inflation hot and run nominal growth hot for the next 3 to 5 years. And we did it from 48 to 53, brought debt to GDP from 120 down to 63. We'll do the same thing this time. We need growth. We need above trend inflation. 3.5 is a good level.
So look, we've got markets hitting near new highs in Europe. We've got near new highs in Japan and parts of Asia. We have the S&P inching forward to breaking out. We've got a number of NASDAQ stocks very close, if not at all-time highs. The markets somehow kind of guessed this was all going to happen months ago, and we've been on a stealth rally for the past few months. Where do we go from here?
We're at a sea change. With the Fed out of the way, what you're going to start to see is a resumption of the downtrend in the dollar, which began in October and was interrupted in the last month in anticipation of the debt negotiations. You had a bid for safety in the dollar. You had a counter trend rally. Now that resumption is going to go downward, and that favors a new group of stocks. So we've been led by tech, the Magnificent Seven that's driven 90% of the rally. Now we're going to see the other 93% of the S&P start to participate. Those 93% of stocks have actually performed 0% year to date. It's those 7 or 8 stocks that have driven all of the gains. And now we're going to get to the 93%. So first off, multinationals that get more than 50% of their revenues abroad, they're going to benefit from a weaker dollar. Emerging markets in China are going to start to get bid materially. Biotech, the risk on trade, as rates now stabilize and we can quantify, you're going to see money move back into risk.
Excellent.
And then finally, interest rate sensitive REITs will start to get bid, and small caps will benefit from bank stability.
I like it. So you're saying there's hope that the rest of us might see our portfolios finally bounce because we've got FOMO on the ones that we already missed. Next time we're going to get some more stock picks from you. Thomas Hayes, good to see you again. Thank you.
Thank you, Phil.